We've got Logan Mohtashami here from Housing Wire. I follow you all the time. So I guess the first question I have for you is just tell us about yourself and your background.
Well, I come from a third generation banking family. Our family has been in banking since the late 1950s. I myself was a loan officer actually from 2003, and I retired early in 2020. I started my financial writing actually in 2010 and had no intentions of doing any of this. And one thing led to another. And then I thought by 2015, I should do this how an analyst would do it and not just talk about the housing market, but talk about all economics and really tie it around economic cycles with a special twist to housing every single day. And I'm here. And I think a lot of people know me for the work I've done for COVID, because years 2020 to 2024 actually mean a lot to my economic work. In the previous decade, I've always talked about this period being good for housing just based on its demographic trends. And COVID-19 came, and then all of a sudden, everybody went into depression mode, and I started writing for Housing Wire, and I came up with a COVID-19 recovery model on April 7th, 2020. And it was so crazy that Housing Wire even thought about maybe they shouldn't publish it, because I talked about us getting a recovery this year. And I'm just a data geek. And I think people know me for charts. And that's kind of what I just do now every single day. And hopefully what I try to do is do what every detective should do: connect the dots for people. And economics done right should be very boring. It's not really designed to be this like fun, hot, sexy thing. And I try to keep it as entertaining as possible, but also teach economics. And that's my old high school basketball coach in me. And I think as long as I teach and people can understand that, I'm doing my job here.
It blows me away because housing is a $1 trillion market, and there's very few people that are this deep into the market as you. There's really a handful that I really follow for my information personally, that really look at it as deeply to the level that you do. So it's interesting. It's good. So what we're going to talk about today is real estate investing, single family real estate investors. So from your perspective, how have the housing dynamics changed specifically for real estate investors?
Well, I think for some real estate investors, prices got so hot so fast, and when mortgage rates shot up in the biggest fashion we've ever seen, a lot of investors pulled back, and some investors didn't flinch at all. So I think the different types of market that investors are in really made the difference in that data line. Of course, if you're always buying, kind of in a sense, distressed properties or properties that need to be rebuilt, you have a little different advantage than somebody looking to pay up in an expensive single family market. So I think there's difference between investors. And we saw the investor demand data fall just like mortgage demand and everything else. I mean, 2022 was the biggest sales crash ever recorded in history for 1 year. Just to give everyone an example, in 2005, existing home sales, monthly sales were trending at 7.26 million. It took 3 years to kind of get down to the 4 million level. We did it in 12 months last year. So the market dynamics definitely kicked some mortgage buyers out and some investors, but investors are still here. And I think the biggest aspect of that is that total active listings are still near all-time lows. So in that environment, those that can get a deal and make the numbers work haven't flinched at all.
You mentioned something. There's different types of investors, right? And if you're Redfin, you consider a real estate investor an LLC purchase, right? That's how they track that.
Mm-hmm.
But you've got the institutions, you've got iBuyers, and then you've got the individual real estate investors that are buying, fixing properties, reselling them, or rentals. Can you tell me how you view those individuals differently, and which models are?
I never understood the iBuyer model, and they just got their heads handed to them. So there's just when you deal with real estate investors, the professional ones that know how to manage the risk understand the value of buying properties at a certain price. I think the iBuyers did not know that, lack of experience, algorithm models that don't work. Then there's real estate investors that are just looking for rental yield, right? Just to buy, not to flip, but buy to rent out for the cash flow. Wall Street was 0.4% of the marketplace at the start of 2020, and they just grew to 2.1%. So they're not as big as people make them out to be, but they have a little bit deeper pockets, but they're not, I would say, savvy investors in the sense of buying distressed properties to flip or to rent out. They have the money for rental yield. So I kind of look at them in that. Mom and pop shops are usually like 94% of the marketplace. So in between that, I think there's the buyers that look for value, and then there's those who look for rental yield.
So Redfin had reported investors leaving the market. Based on our survey data, investors are still pretty bullish. Now, can you comment on that at all? Like, who's leaving the market right now? What people?
I think anybody that was tied to mortgage purchases, the interest rates going up didn't make sense for a lot of people that are investors. I think those are the ones that left the marketplace. I think for other investors that are looking for value and to make money because of the value purchases, I think they are still in here. A good example today, the existing home sales report, the year over year investor percentage is only off by 1%. So it's not like it's a big collapse. I do believe the iBuyers are majorly gone for the market. Of course, Zillow left already, and the other ones are slowly winding down. There's not that many purchases being done. In that sense, you can make sense. But the savvy investor who knows how to find property, find value, is still here, and that's why you saw a decline in the year-over-year data, but you didn't really see like a historic crash.
Yeah, you saw institutional buyers drop by 80% in a short period of time, their transactions, along with iBuyers. So, but it just shows you how small that part of the market really is.
It shows how small, but there's also something to say about experience. You could give a lot of money to a few people and they can go into a market and, they can be sloppy and good at the same time in certain markets. But when things change, I think that's where the experience shows up. And this is why investors themselves as a percentage have been higher than historical norms for well over a decade now. Of course, after the financial crisis, the housing crash, there was a lot of bulk buying of distressed properties for 26 to 36 cents to the dollar and then flipping them right away. It's not that type of marketplace. So I think the experienced investors is still here, and they're doing what they do because the supply level of active listings in America is still very low, and that fits more into their models of buying something cheap, providing, let's just say, an affordable house compared to what the market is. And when the market has this low of an inventory, that dynamic has not changed, regardless of the demand being lower this year than last year.
So that's interesting. I mean, we're in an infrastructure crisis right now. I think you could describe it, the affordability crisis that we see in single family real estate. How are investors, the investors that we're talking about, the individuals, the independent investors, how are they affecting that dynamic?
Well, they're doing something that I don't think people give them credit for. They're buying properties that it's not livable or it needs a lot of work, and they're providing it into the marketplace, not as a kind of an expensive, lavish house in the upper price range, but something that was never going to be part of the housing inventory marketplace. And here is in a supply that is most likely cheaper than the general marketplace, and that in its sense is actually a supply creator, where other people just wouldn't be doing that.
It's a supply creator because most of those houses are generally vacant.
Yes, they're generally vacant and they need a lot of work, or just even homes that need minor work. I think that's what the investor does. They come in there and they do what needs to be done to be able to sell the home for the right profit margin. Where I think you don't get that in a traditional first-time home buyer or a move-up home buyer or move-down buyer. They're not. They can look to make some remodeling changes, but they're not really in that type of marketplace. So it is a buyer, and I've always said, sellers are buyers in the housing market. So you have to have somebody come in there and that want to do the work.
Sellers are buyers, and that's the problem with inventory today, right? I mean, it drops like a rock because
yes, it's been a long downtrend. It's been a big part of my work for some time, but credit channels are much different now. So I always say credit channels are running inventory channels, and what's occurred is after 2010, everybody just got 30-year mortgages, and it's pretty boring, pretty vanilla. But when you have a 30-year mortgage, it's a fixed debt cost and your wages rise every single year. So people are living in their homes longer and longer. From 1985 to 2007, it was 5 to 7 years. And from 2008 to 2023, it's 11 to 13 years, depending on who you listen to. In some parts of the country, it's 15 to 18 years. I mean, I've lived in my home for 19 years. So that dynamic, better credit channels, housing 10 years double, these things have led to total active listings falling every single year. And of course, when you have first-time home buyers in the market, they're not providing a house. So they're taking that home off the market without putting one in. So slowly it's been moving. And when 2020 came, we just broke to all-time lows in total active listings, the worst time ever, because we have the biggest housing demographic patch ever in history during this period of time. And people saw what happened. We have too many people chasing too few homes. And that aspect hasn't changed as the NAR report shows today. Total active listings is actually down year over year, and we're in June. You know, this is when you're thinking of housing crashes or big supply, you should be up significantly year over year, but we're down because some of the core things that have been in the housing market for the last decade have held their course, and we are just in a, as I call it, a savagely unhealthy housing market because there's too few homes on the market and there's obviously demand there to buy.
And COVID, you know, it was happening before COVID, but I think COVID really, or the response to COVID, ensured that we are not going to see strong supply anytime soon. I mean, everybody that could be refinanced was at historically low rates, right?
Yeah, even if that didn't happen, the inventory situation would still be somewhat similar. What occurred is, you know, here's a good example. In 2018, when mortgage rates got to 5%, there were parts of the country that saw a little bit of inventory growth year over year, but as a country, not much. Even back then, when rates were high and demand fell, total active listings didn't grow, and they were near historical lows anyway. But what happened is, you know, housing broke out before COVID started. You know, ages 28 to 35 are the biggest in America. So we ran into this first-time home buyer batch. That's a little bit more than what we had in the previous decade. And inventory broke. And even if rates were never broke under 3.5%, we'd still have this inventory situation just because the credit channels are different. And when you get more first-time home buyers, they slowly drain that inventory out, and people just staying in their homes longer and longer.
I mean, this is a big problem in the U.S. You know, the way you create wealth for the middle class is you own a home, and if houses are unaffordable, I mean, that's a major challenge. How do you fix? What are some of the ways you can fix the supply issues we have in affordability?
You know, the majority of the homes that come to the market come from the existing home sales market. So when we build homes, like for example, the single family new homes data, I always ask people when I speak at events, does anybody know how many new homes are available for sale? And nobody has the answer. And I say, there's only 70,000. That's it. That's the 70,000 are the active completed homes for sale for a country of 330 million. But the thing about the new home sales market is that when you sign that contract, you're going to occupy that house, right? When it's done building. So it's not like that inventory is available for people to buy. When demand gets weaker, active supply can grow, but nothing in a big fashion. So It's a difficult problem to buy, but I do think in this sense, this is where the real estate investor can bring something that's not into the market, and create more supply in that category, which is a positive. That's what we need. We need people to bring as much product onto the system as much as possible. I'm a very pro supply person, but understanding how difficult it is, investors in this way are providing a very good source of new supply that isn't in there.
So if you're a young person and you want to build wealth in real estate, but you live in maybe a city where it's just not affordable, it's not going to happen. Are you seeing, I mean, you had mentioned the 30-year fixed mortgage. I'm with you on that is the weapon that you have against inflation. Can you explain why that might be important for a young person buying a rental?
It's a very fun time for me because I've never been able to talk about housing as the best hedge against inflation, because inflation for this century was very low, so there was no need to. But this concept of the best hedge on planet Earth actually was a 30-year mortgage in America. A lot of other countries don't have 30-year fixes. They're tied to short-term rates. So when I say the best hedge against inflation, you have a fixed debt cost, right? That doesn't change. Your property taxes or insurance but your fixed debt cost stays the same. What happens during an inflationary time is that your wages rise faster. So your total housing cost in regards to your debt cost gets less and less every single year. Well, that's been happening for years anyway, because people had a fixed debt cost, and we've had 3 refinancing waves, 2012, 2016, and then 2020 and 2021. Now, all of a sudden, people living in their homes longer and longer, here comes inflation, your wages grow up, your costs are low. It couldn't be any better for America. I mean, the whole concept of this is being tested in the biggest fashion, and Americans are doing good, right? Their total wages are so low compared to their housing costs, and because you make more money as you get older, so of course, if people living in their homes longer, this became the best hedge because your cost of housing is low. If you're a renter now, you don't actually have that benefit, right? Your rent goes up every single year, so you don't have that fixed housing cost. Here, 30-year mortgage, and I tell you, there are a lot of countries out there in America or around the world that hate us even more because we have this fixed product. In fact, our levels of risk are to ARM loans or recasting loans are the lowest on planet Earth. Other countries, Canada, Norway, Sweden, Australia, all these countries have short-term recast rates or refinancing rates to short-term. I mean, their costs are going to go up. But in America, 30-year fixed mortgage, wow, it could not have been any better. You had COVID, you had forbearance, you had inflation, high rates. The American homeowner just, kind of dusted off the crisis and just said, we're good, right? And that's, you get tested in this kind of environment by 3 different big things, and they all passed with flying colors.
You know who said that? That the 30-year fixed Fannie Mae mortgage was the world's best hedge against inflation. 10 years before you, 15 years before you, Warren Buffett.
Buffett, okay.
He said that on CNBC in 2008 or 9, and some very happy people listened to him, and picked up rental property and all that. But it's good. It's fantastic. We're seeing Gen Z living in Seattle, living in Los Angeles, buying rental houses in Greenville, South Carolina, right? And putting fixed mortgages on them and doing well, right? Buying in areas where they can afford properties and obtaining that hedge.
Yeah, and one thing about Gen Z is that they're actually buying homes faster than their parents, younger, because what's occurred lately is people have been buying homes later and later in life. I kind of had this skit for the last 10 years, we're not very hard people to model out. We rent, we date, we mate, we get married 3.5 years after marriage, we have kids, ages 28 to 35 are the biggest in America. Housing was a years 2020 to 2024 story. Pregnancy tests started to take off in 2020, right in line. So if you do that with a fixed debt cost and then your wages are rising, and if you refinance even better and better, it's such a unique advantage because everything is now after 2010, everybody just gets 30-year fixes for the most part. They're all the ARM loans, all the recasting, all those exotic loan debt structures that we saw that were rampant from 1996 to 2005 are mostly all gone. Even the ARM loans that they do now, the debt structures are different in the qualification. So hopefully by now that we're in June of 2023, everyone can see what, owning a house or owning a fixed debt cost, as Warren Buffett says, the best hedge against inflation, but it's also the best hedge against economic turmoil, right? Because you have a very low housing cost in relationship to your wages, especially if you've lived in your homes longer and longer.
Makes sense. Everybody is in agreement, I think, on that one. Tell me, do you think family formation is going to continue to outpace new homes?
Just because construction is low and, immigration is picking up again. For a while there, it was in decline, and we're starting to get people back coming into this country. So household formation for many years was actually lower than what the total housing construction was. And naturally, this is the one benefit the United States of America have. We have a lot of millennials and we have a lot of Gen Z. Gen A is way too young yet, but other countries, Japan, China, and Europe, their total population growth for prime age labor force are done. They're in decline. We have decades and decades of still growth. Now, the growth rate is going to be slow compared to what we used to have, but naturally, when you're a bigger rising population, that does tend to happen. But we have this demographic muscle where the millennials and Gen Z combined are bigger than the total population of Japan. So I always thought that our strength as an economy actually came from our demographics. For a mature economy of our size, to have young replacement workers and consumers, it's a benefit. And this is why our recoveries are faster, especially here in COVID compared to other countries. We just have younger people who consume goods and services in a different fashion than older Americans. And you put them and the baby boomers together and Gen X, you've got some kick there on the demographic side.
It's a pretty positive conversation. It's not what everybody wants to hear on the mainstream news these days.
Right? Yeah, I think, if it bleeds, it leads. And, housing, I always joke that I have a very toxic but loving relationship with the housing bubble boys, the crash people for the last 11 years. It's almost like a Batman Joker relationship. And I think it's a good business model to be kind of a doom porn person. Because you could generate the clicks, but economics, if you do it the right way, it's not really designed for that. That's kind of why I've never had my own YouTube page, because I couldn't do anything that exciting, so I just chart models out every single day and look at bond yields and stuff like that. And it's just not the most riveting thing, but try to teach that economics itself, anybody can kind of learn it and understand it, but the big crash theories of just haven't worked the last 11 years, because what happened in 2008 was so unique. It's much different now these days. Traditionally, you don't have a bubble in the same sector back to back. It historically doesn't happen that way. And hopefully now that we're in 2023, people can understand that the dynamics currently are so much different than back then.
Very different. I think we had a lot of people comparing this to 2008 in the beginning, and now I think that people are seeing the light.
Every year it's 2008 for me for the last 10 years. So I've
if you're in California, yeah, as well.
But it's just in general. And I think what I always try to do is I try to explain to people 2008 wasn't really even about 2008. It was 2005, 6, 7, and 8. We had 4 years of credit stress in the system before the job loss recession. People were filing for foreclosures and bankruptcies, and credit stress was building up while the unemployment rate was falling. None of that's been happening for the last 10 years. Credit stress is very little. You would need at least 4, 5, 6 years even to build up the kind of credit stress we saw back then. Then the job loss recession has to come in year 7 or 8. So it's such a different dynamic. And what I try to do is do the nerd tour and travel around the country and bring my charts with me and try to explain people that. I think once people visually get to see the data, they understand it better.
I mean, it's mind blowing. I just saw a bunch of it in Austin when we were there. But I think a lot of the headlines are based on real estate sales plummeting. But that's very different than the asset. You can bifurcate those two things. So if you're a broker, that's, the transactions down it's a bad thing for your P&L. But if you're a real estate investor and we're looking at the asset, can you help them understand that?
It's interesting. For years 2020 to 2024, one of the biggest, if not the biggest concern, was home prices escalating out of control. If demand picks up and inventory breaks, that's what happened. And what occurred is that I had a model for this year, for this actually period. I said, as long as home prices just grew at 23%, we would be okay with sales. That obviously didn't happen. 2 years, we went over 30%. And when rates rose, it crashed demand. But rates didn't just rise normally, like 1 to 1.5%. Rates went from 3 to 7%. What that did is facilitated the biggest decline in home sales ever recorded in history. And total inventory today in the existing home sales report is down year over year. On our weekly tracker inventory data, it's going to be negative year over year soon. So the dynamics are different, where you can have home sales crashes, but the prices doesn't necessarily follow the volume. A lot of people go, well, price follows volume. That means home prices are going down 20, 25%. In 2023, that didn't happen. So what occurred is that demand stabilized. And once demand stabilizes, we're back to a stable market, even though sales are very low, but with low active listings. I think that's the different dynamic, where in 2007, we had 4 million active listings. We had a lot of supply back then. Here, 2023, even after the biggest crash, we have a little bit above 1 million. So much different marketplace. Historically, if we want to use the NAR data, we're between 2 to 2.5 million going back to 1982. That's just normal, right? What happened in 2005, 6, 7 was forced credit sellers. They don't buy homes, right? You're basically selling to either rent or be homeless. You're not selling to buy another house. So you lost that, inventory range that we have been, and even with sales crashing, we have not seen that inventory spike. And in fact, a lot of the home price indexes are actually back to all-time highs already. And it's firming up on the month-to-month prices. This is with rates at 6 to 7%. Imagine if rates were back to 5%, not even talking about 3%, but just at 5%, you get more demand in a very stable and low inventory market.
I was shocked by how stable demand was in the 7s. I wasn't expecting it. Were you surprised by that as well?
I was not, in the sense, and this is probably one of the things I always have to explain to everybody, because even people that I work with ask this: why is housing demand stable with rates at 6 to 7%? You have to look at it in this light. Existing home sales after 1996, it's really rare to get under 4 million. What I talk about, the 4 million buyer market, these are the top of the food chain of home buyers in America. We briefly went under 4 million in 2008 for a few months, and that was it. Here, all of a sudden, we have the biggest home sale crash in history. But on November 9th, back in 2022, I talked about, it looks like existing home sales are going to be running at 4 million. If that happens and rates fall, if demand stabilizes, that changes the marketplace. And that's what occurred from November 9th all the way down to December, January. Purchase application data started to get better, and you just got to go with that data. That means you have to track weekly data, and kind of that was it. Since that time, we've had 19 positive purchase application data prints versus 11 negative. So the data stabilized right at the level where I thought, okay, we're dealing with a different type of home buyer here. This is the top of the food chain. So the affordability crisis doesn't impact them as much as we had those buyers from 6.5 to 4 million. So I always say the marginal home buyer got wiped out last year, but that core base 4 million, which I even talked about in the summer of 2020, is still here. And that's how demand is stabilized. We're just dealing with a more affluent home buyer at this level. And they've been here since 1996, whether rates were at 8%, 6%, 4%. I think what shocked a lot of people is that rates just going from 7 to 6% made the difference. But if you look at it as we got 156 million people working, can we get those 4 million buyers, dual household incomes, cash buyers, all those things, put it together? That's not really asking a lot for a country of our economic wealth and our wages, actually. So think of dual household incomes coming together. That's the best home buyer weapon against big inflation data or mortgage rates going up higher.
Where do you see, and I know you've got models for a variety of scenarios, but where do you see how home prices trending in
So
the next 5 years?
as long as mortgage rates stay below 5.875, even with the price inflation, prices should just be flat to up, considering what has occurred. If mortgage rates get to 8 to 9% and stay there, and you start to get a rise in inventory, what we saw last year could occur, but we're at such low levels. So I think the dynamics are: what if mortgage rates do fall? How much can sales grow again? At what point does the recession happen? There's all these different things, but clearly, even with the biggest crash in home sales, we did see month-to-month price declines last year in the second half, but that all stopped. If the growth rate of inflation falls and the economic data gets a little bit softer, mortgage rates should fall. And in that environment, it's hard to have price crashes with low active listings and stable demand. That's why I always talk about that 4 million level. Use that as a barometer, and always track weekly inventory data. They'll give you the best clues. For example, new listings data is trending at all-time lows this year. I thought one of the funny grifts that I saw in 2021 was that all investors were going to rush to the hills and sell their homes, once rates rose, and we're going to see active inventory get 4 or 5 million. That never happened. New listings data was trending at all-time lows in 2021. In 2022, we all saw some growth year over year in some weeks, but nothing big. And then when rates went up, new listings data started to decline, created an all-time new low data line set. So people love homes, and you don't sell your home to be homeless, right? Unless you're forced to sell. That's a job loss recession theory. So far, we're not there yet.
So, I mean, if rates stay high, we're getting into the 8s, 9s, which I believe is possible. You're not in the middle of a job loss recession if that's happening.
No, traditionally, yeah. I mean, there is a theory that if this was like the 1970s, in the 1970s, people will forget that rates went up during the recession periods, but the economics now don't resemble what we saw in the 1970s. So this is why bond yields are still low, even though the growth rate of inflation is high compared to what we had so far this century. But I think everything just kind of goes back to norm. The history of global pandemics, it's very inflationary the first 2 years, and then the disinflation aspect happens after. So there's nothing to me that changes the long-term dynamics. I mean, of course, war or supply shocks or anything like that is inflationary. That's what we've seen, post World War I. But without that, the growth rate of inflation should be stable, like it was from 2000 to 2019. Very stable growth rates of inflation. Mortgage rates were trending lower for years. That dynamic shouldn't change unless you really believe in the 1970s. And the 1970s rent inflation took off. We had 20% rent inflation on the CPI data. Our rent inflation that we've seen right now, the growth rate is already cooling down. Doesn't resemble what we saw in the 1970s.
And if we run into a job loss recession, hard landing, should I, if I'm a real estate investor, should I be afraid of that happening?
This is how I'm modeling out a recession, similar to what I did during COVID. In COVID-19, people said, why do you think people are going to buy homes? There's 20 to 30 million unemployed. I go, you're forgetting the 133 million people working, with lower rates. Now, the affordability is much worse now than it was back then. But if rates fall down, I'll look at it in this two time frames. Number one, 42% of all homes in America don't have a mortgage. You can have, in a sense, a forced equity seller, somebody that's not in foreclosure, that just lost their job, but the job loss recession shouldn't be that big, especially compared to COVID. That could create some supply. The foreclosure supply, on the other hand, is going to take some time. 30, 60, 90-day lates are at all-time lows. So it would take, at minimum, 9 to 12 months from the first few job loss reports for that process to even get the supply on. In some states, it's going to take 12 to 18 months. But during that time frame, you still have over 156 million people working. So assume that you lose 2 to 3 million. that still has a lot of people in the workforce. And if mortgage rates fall, they buy, just like they did in COVID. They took advantage. So I really think when the next recession comes, how far mortgage rates can go lower and where are we working from? If we're working from 6.5 million home sales, that's different, right? That's a very high level of sales in the 21st century. But at 4 million, boy, that's very low. And it's a stable market already with higher mortgage rates. You can't fire enough people to offset the massive labor force that's working. I always say this, like, think of it as war. You got 2 million people working for you or ready to battle. I got 154 million people here. I'm going to win this battle no matter what, because when lower rates happen, it disproportionately impacts the housing market in a positive way. Just like last year, we had a great labor market. Everyone was working, but mortgage rates went up so much so fast that it disproportionately impacted housing in a negative way. So that's how you should look at housing going into the next recession. And just remember, 30, 60, 90-day rates are at all-time lows. It takes time to get that foreclosure supply into the marketplace.
Certainly if you're a home flipper, you're acquiring an asset that you can add value to. You're going to add square footage. You're going to do something unique that only you know how to do. That hold time, a year, 6 months. A lot's got to change in that period of time, right? And we don't see real estate prices falling off a cliff.
For prices to fall off the cliff, you would need major inventory increases and forced credit sellers. We saw prices decline on a month-to-month basis last year. That was also the biggest home sale crash ever recorded in history with low active listings. That dynamic has changed. Because that dynamics have changed, pricing has firmed up. So if you get another, it'd be very hard to go from 6.5 to 4 million to 2 million with how many people we have working. So you would need forced credit sellers, foreclosures. That's something down the line. A lot can happen with mortgage rates from that point and on. So for us, we always track the weekly data. So we get the new listings data and active listings, and we keep an eye on this. But it's not shocking that inventory is down year over year.
We're seeing, despite a lot of the macro coverage being somewhat negative in the mainstream media, why do you suppose so many of our investors are so bullish? The majority of them would like to continue investing through the second half of 2023.
I think they just see what everyone else sees. Low active listings and demand has stabilized, which means that if you bring something to the market, demand is still stable, you have a bid. If rates go lower, you got more people bidding. That's kind of the marketplace. It's very strange. To me, I totally understand. People just saw home sales collapse faster than they saw the financial crisis, and literally prices aren't crashing and inventory isn't rising. So your investors are probably seeing what a lot of people are seeing. There's just not a lot of homes in the marketplace. Here we use Altos Research as part of Housing Wire Media now. Last year, total single family listings at the lowest point was 240,000. That was it for all the homes available. This year, 451,000. Back in 2015, it was 1.2 million. So the active listings parts, is just so low. And if demand is stable, you're in that environment. So your investors are seeing what I'm seeing in the data, what any data analyst, a stabilized housing market in demand with low active listings historically and a massive population. So when you think of housing demand, it's just not first-time home buyers. It's move-up buyers, move-down buyers, cash buyers, investors, first-time home buyers. Whoa, we got a lot of people here. And to just generate 4 million monthly home sales in this environment, it's not that difficult unless rates go out of control. Credit getting tighter is not a thing for housing. For the commercial real estate industry, yes. But for here, since Freddie and Fannie are not publicly traded companies, they're in conservatorship, they can keep the credit flowing.
So that's interesting, because in our survey, we ask the same questions every year, and we always get the same answers in this category, which is the biggest problems that biggest challenges that real estate investors see. It's always finding the property.
Yeah.
Second challenge is the finance.
That's
third is the labor and the material.
Yeah.
Always. And it's in that priority.
When you're at record lows of inventory, the homeowner vacancy rate is 0.8%. There's just, we have so many more people than we did in 1982, but we have so much less inventory than 1982. So a lot of people, not a lot of homes, too many people chasing too few homes. So that's what the data shows us. When home sales are crashing like they did last year, that dynamic changes. The low inventory isn't as big a shield because whoever has their product out there selling, some of them need to cut their prices to get the home sold. But that's not the market today. If that variable changes, that's different. But as of now, that 4 million data line held. It held during COVID. It held after 2008. But after 2008, active inventory was so much higher than what it was right now, and distressed sales were picking up. Here, totally different marketplace, much lower inventory, hardly any distressed sales out there.
So what else do you think we can add that real estate investors need to know about the outlook, over the next 5 years?
I just think to track inventory data, because the demographics ages 30 to 39 are there for this decade. The silver tsunami where the baby boomers selling all their property, that's something that toward the end of the decade, death, I would say no country has a Dorian Gray labor market and nobody goes through the grave with their homes. So when people die and give their homes off to their family members, what their children do with it or spouses, that's something we'll cross the bridge toward the end of this decade as more and more people get into their 80s. But as of now, follow the data. Everyone can see what's going on. Demand stable, active listings are low. Those are the two big things. If those variables change, then it's a different story. But as of now, they haven't. And I think your investors have seen what the marketplace is seeing. People need homes, not a lot of them, and they're looking to get a deal out there.
Okay, one last question. The NAR put out a great report. They really broke the housing demand or the need for supply into categories, price categories. And there was a couple bands that were most important, right? The affordability bands, $250,000 houses, and the $341,000 houses. And it looked like we were missing 320,000 $250,000 houses, and we were missing 285,000 $50,000 houses. That price point right there is very important, but that's not what builders are delivering, right?
Oh, the builders have built bigger and bigger homes for many decades. 1975, it was 1,500 square foot. The peak recently in 2014 was 2,700 square foot. So bigger homes, more expensive homes. They have all the bells and whistles. So there is a marketplace, of course, for existing homes that are in that category. And man, these homes just go so fast just because everyone is clamoring to have some kind of product. If some of you are old enough, the old Hungry Hippo game, where people actually just sit there and they try to grab as many balls. There's not a lot of balls out there for the price range. So if something comes to the market, you typically have a buyer. That's where we see the multiple bids happening. We just have a lot of people. We have a lot of people, 156 million people working, 330 million people in this country, and some of them need a house. And you just keep it as simple as that. In that price range, there's a lot of demand for it because obviously the builders have not really kicked in that area. And then a lot of homeowners are sitting in their homes, living a great life, their best hedge against inflation. And it's just a hungry hippo game for the buyers out there.
The investors don't get enough credit for supplying that.
Yes,
that supply.
That's very true.
Yeah, that's for sure.